On April 21st, 2026, United Airlines reported a quarter that somehow managed to be both excellent and alarming at the exact same time. Adjusted earnings per share of $1.19. Revenues up more than 10%. Premium and loyalty revenue both growing at double-digit rates. And then, in the same press release, the company cut its full-year earnings guidance nearly in half, from $12 to $14 down to $7 to $11. That is not a rounding error. That is a message.
The message was fuel. A spike in jet fuel prices driven by geopolitical tensions in the Middle East, specifically an escalation involving Iran, pushed United's fuel cost to $3.51 per gallon in Q1. That is $1.12 above the company's pre-conflict baseline of $2.39. The difference cost United $340 million more than expected in a single quarter, and the company has no certainty about where fuel goes from here.
Welcome to Charged Alpha. I'm Hudson Thomas, here with Lana Chen. Today we're breaking down United Airlines Holdings, ticker UAL, the Chicago-based aviation giant that just delivered one of the more complicated earnings reports of the year. A 10% revenue beat, a premium cabin story that is genuinely working, and a guidance cut that reminded the market exactly how exposed airlines are to a commodity they cannot control. Let's dig in. United Airlines Holdings was incorporated in 1968 and is headquartered in Chicago, Illinois, though the flying operation traces its history back to 1926. The company employs roughly 109,000 people, operates through 6 major hub airports: Chicago O'Hare, Newark, Houston Bush Intercontinental, Denver, San Francisco, and Washington Dulles, and runs approximately 1,000 mainline and regional flights per day.
United makes money the way all network airlines do, by selling seats at prices that exceed the cost of fuel, labor, and overhead. But the last several years have seen United deliberately shift its revenue mix toward premium. Their Polaris business class product targets corporate and premium leisure travelers who pay significantly more per seat than economy passengers. The Mileage Plus loyalty program generates high-margin co-branded credit card revenue. And cargo holds a meaningful slice of international long-haul economics. The goal of the United Next strategy is to reduce reliance on any single revenue stream and build a brand that commands pricing power.
The moat here is real and multidimensional. First, United holds gate rights and takeoff slots at the most congested airports in the United States. You cannot just start flying from Newark or O'Hare at scale. Second, the Mileage Plus program has tens of millions of members and a deeply integrated Chase co-branded credit card relationship. Third, the Polaris cabin is genuinely competitive with Delta One, which is the gold standard in domestic premium. And fourth, United has over 300 aircraft on order, a fleet refresh that will structurally lower fuel and maintenance costs over the next decade.
The why now for Q1 2026 is the collision of a strong execution story and a brutal commodity environment. United delivered premium revenue growth of 14% year over year. Loyalty revenue grew 13%. Business travel came back 14%. These are real numbers, showing that the brand investment is working. At the same time, a global fuel spike cut the full-year earnings outlook by roughly 40%. The stock sold off on that guidance cut, which sets up a thesis debate. Is this a structural buying opportunity in a great airline, or a reminder that airlines are inherently fuel-exposed cyclicals?
United's CEO is J. Scott Kirby, who took the top role in May of 2020, one of the more memorable moments to become chief executive of a major airline. COVID had just shut down global air travel. United stock had fallen from over $90 to the mid-20s. Kirby stepped up and immediately pivoted to survival mode: government assistance, workforce management, and setting the strategic groundwork for what would become United Next.
Kirby is not a banker or a marketer. He has a degree from the U.S. Air Force Academy and a master's from Stanford, and he built his career in revenue management and network strategy. He was president of American Airlines from 2013 to 2016, then president of United from 2016 until he became CEO. That means he has been deeply embedded in United's operations for a decade. The United Next plan, the fleet ordering program, the Polaris expansion, the loyalty restructuring, is his blueprint, not an inherited one.
The thing that stands out about Kirby's approach is the explicit focus on revenue diversification. He talks about United as a brand-building enterprise, not just a seat vendor. And the Q1 2026 numbers, premium up 14, loyalty up 13, suggest that framing is actually materializing. His Q1 commentary was direct. He acknowledged the fuel pain, cut guidance proactively, and framed it as a near-term disruption to a long-term strategy that he believes is structurally sound. Industry analysts consistently rate United's execution under Kirby above peers. Take us through the Q1 2026 financials.
United trades at $97.13 per share, with a market cap of approximately $31.5 billion. The trailing GAAP price-to-earnings ratio is 8.66 times, cheap by most standards, though airlines historically trade at low multiples for good reason. On a price-to-sales basis, it's 0.52 times, which reflects how thin airline margins are relative to revenue. Price-to-book is 2 times. EV to EBITDA is 6.46 times, no dividend. The company is directing cash toward debt reduction and capital investment rather than distributions.
Walk us through the income statement.
Q1 2026 revenue was $14.6 billion, up 10.6% from $13.2 billion in Q1 2025 and 1.5% above the $14.4 billion consensus estimate. Gross profit was $9.1 billion. Operating income hit $997 million. EBITDA for the quarter was $1.3 billion. Net income came in at $699 million on a GAAP basis. That's a GAAP diluted EPS of $2.14. The adjusted EPS that analysts were tracking, which strips out non-cash and one-time items, was $1.19. That beat the $1.08 estimate by exactly 10.2%. GAAP was boosted by unrealized investment gains and other non-cash items. The adjusted figure is the more meaningful comparison.
The revenue breakdown matters here.
It really does. Premium cabin revenue grew 14% year over year. Loyalty revenue, the Mileage Plus co-branded card and partner ecosystem, grew 13%. Business travel revenue grew 14%. Basic economy was up 7%. The diversified structure meant that even as macroeconomic concerns swirled, the higher margin revenue streams were outpacing capacity growth.
And the cash situation?
Very strong liquidity. Cash on the balance sheet is $7.87 billion. Add in $6.3 billion in short-term investments, and total liquidity is $14.2 billion, more than enough runway. Operating cash flow for Q1 was $4.8 billion, driven in part by advance ticket sales for summer travel that flow through as deferred revenue. Free cash flow was $3.1 billion. Total debt is $28 billion, with a net debt position of $20.1 billion. The balance sheet is levered, debt to equity of 1.76 times, and that leverage is always the tail risk in a demand shock. But with $14 billion in liquidity and strong free cash flow generation, the near-term obligations are manageable. Overall, United Airlines' financial health is watchful. The company executed a strong Q1, maintains $14 billion in liquidity, and is generating real free cash flow. But the guidance cut to $7 to $11 in adjusted EPS reveals how exposed the earnings model is to fuel, and $28 billion in debt leaves limited margin for error in a downturn.
What does analyst sentiment look like on United right now?
Extremely bullish, which is notable given the guidance cut. About 24 analysts cover United, and the consensus is a strong buy. 22 buys, 2 holds, 0 sells. The average 12-month price target is $131, which implies approximately 35% upside from the current price of $97.13. The target range runs from $110 on the low end to $156 on the high end. That's a wide range, and it reflects the genuine uncertainty around where fuel settles.
Who moved their targets around?
Heading into Q1 earnings, virtually every major airline analyst cut their price target on United, but kept the buy rating. Citigroup took its target from $155 down to $132. Wells Fargo went from $145 to $130. Jefferies from $148 to $125. The pattern is: acknowledge the fuel headwind, lower the target to reflect reduced 2026 earnings, but maintain the thesis that the underlying airline and the premium strategy are worth owning through the cycle. TD Cowen, UBS, Evercore, and Rothschild all maintained buy or equivalent ratings in March.
How did the stock react on earnings day?
It sold off after hours. The 10% adjusted EPS beat was real, but the guidance cut from $12 to $14 down to $7 to $11 for the full year was the headline the market reacted to. The high end of the new guidance still implies a very attractive stock at these prices. $11 in adjusted EPS on a $97 stock is an 8.8 times multiple. The floor at $7 looks more sobering, but analysts are betting that number reflects a worst-case fuel scenario.
Let me make the bull case for United. First, fuel prices could normalize. The current fuel spike is tied to specific geopolitical events, an Iran conflict. If tensions ease and jet fuel pulls back from $3.51 per gallon toward the $2.50 to $2.80 range, United's guidance has room to recover sharply toward or above the $11 upper end. That alone could be $2 to $3 of additional annual EPS. Second, the premium cabin strategy is working right now, in real numbers. 14% premium revenue growth is not a press release, it's cash. Third, Mileage Plus is a structural advantage that does not correlate with fuel costs. Loyalty revenue grew 13% quarter over year, and it will keep growing regardless of what oil does in the next 90 days. Fourth, the A321XLR aircraft deployment opens smaller European and Latin American markets that were previously unviable with wide-body economics. That's new revenue without massive new capital. Fifth, at $7 to $11 in guidance, the stock trades at 8 to 14 times earnings. If the industry normalizes and United executes its United Next plan, this looks historically cheap.
The bear case is equally important. Start with leverage. United carries net debt of $20.1 billion on a $31 billion market cap. That is a fundamentally different risk profile from Delta, which has meaningfully lower leverage. In a demand shock scenario, recession, pandemic, another travel disruption, United has less financial flexibility to absorb losses. Second, the fuel exposure is structural, not one quarter. Airlines cannot fully hedge their way out of sustained high fuel prices. Every 10-cent increase in fuel costs United roughly $100 million annually. If the Middle East situation escalates further or energy prices remain elevated, the $7 floor of guidance could be tested. Third, demand is decelerating. Post-pandemic revenge travel has been fading, and while premium and loyalty are holding up, the core leisure economy market is showing slower growth. A broader consumer spending slowdown hits airlines hard and fast. Fourth, the guidance range of $7 to $11 is so wide it signals genuine uncertainty. Management itself is not sure where the year lands. Fifth, insider selling with zero purchases. Pure selling over the last 6 months is a weak signal, but it is the signal.
How does United stack up against peers on valuation?
United's price-to-sales ratio of 0.52 times sits in the middle of the domestic airline peer group. Delta Airlines, which is generally considered the premium comp, better margins, lower leverage, dividend-paying, trades at approximately 0.8 times sales, a premium that reflects Delta's tighter balance sheet and stronger recent earnings consistency. American Airlines trades at a deep discount of about 0.13 times sales, but that is not opportunity, that's distress. American carries roughly $40 billion in total debt, and its equity is essentially a highly levered option on the airline recovering. Southwest Airlines is at approximately 0.55 times sales, very close to United, but Southwest is in full restructuring mode under a new CEO, cutting routes, trying to find profitability after years of underperformance.
So the honest read is that United sits in a fair value range for a major network carrier.
That's right. It's not obviously cheap relative to Delta, and it's not distressed like American. The premium thesis, if the Polaris cabin and loyalty strategy continue to close the gap with Delta, is the argument for United deserving a re-rating over time. At current prices, you're essentially paying for solid execution with a significant fuel wildcard embedded.
On the options side, specific put-call ratio and implied volatility data were not available for this episode through our primary sources. What we do know is that United carries a beta of 1.29, meaningfully above the market, which means option premiums on UAL are generally elevated relative to lower beta stocks. The guidance cut created unusual post-earnings dynamics where the stock sold off despite the Q1 beat, suggesting the market was caught somewhat off guard by the magnitude of the full-year revision.
Airlines consistently see elevated implied volatility around earnings because fuel, demand, and macro variables are all moving simultaneously. The Q1 2026 setup was particularly complex. The beat was real, but the guidance cut was large. If you were long calls into earnings expecting a clean beat reaction, the post-guidance cut sell-off was a reminder that in airlines, the full-year outlook often matters more than the quarter. United's relatively low stock price relative to analyst targets suggests the implied volatility market is pricing in a wide range of outcomes for the rest of 2026.
On the insider side, the picture is straightforward and worth noting. No open market purchases from United insiders have been reported in the last 6 months. The president of the company, Brett Hart, sold 19,000 shares in February of 2026 for approximately $2 million, consistent with a pre-scheduled 10b5-1 compensation plan. There have been approximately 6 sales total and 0 buys across executive ranks.
The caveat on insider selling is that the vast majority of executive transactions at public companies are pre-scheduled through 10b5-1 plans precisely to avoid the appearance of market timing. The absence of purchases is the more informative signal, and the fact that no senior leader chose to add to their position while the stock traded below its 52-week high is a mild negative tell. Not alarming, but noted.
The key risks for United going forward. Risk 1, the fuel price environment. At $3.51 per gallon and rising, every cent of further escalation is a direct EPS headwind. If the Iran conflict intensifies or broader Middle East tensions keep oil elevated, the 7 to 11 guidance range could skew toward the floor. Risk 2, demand deceleration. Premium and loyalty have held up, but basic economy is showing slower growth. A recession scenario hits all revenue streams simultaneously, and United's leverage amplifies the impact. Risk 3, tariff headwinds on aircraft parts, maintenance equipment, and supply chain inputs. Boeing and Airbus delivery delays could slow the United next fleet renewal that underlies the unit cost improvement thesis.
Risk 4, refinancing pressure. Net debt of $20 billion at rising interest rates increases the cost of rolling existing obligations. And Risk 5, competitive dynamics. Delta continues to execute at a high level and Southwest is restructuring under a new CEO. If Southwest emerges leaner and more competitive in domestic markets, United faces direct pressure in the mid-tier pricing bands that connect its hubs. The single watch point that matters most heading into Q2, the realized fuel cost per gallon. That number will tell you almost everything about where the full-year EPS lands in the guidance range.
So what is the bottom line on United Airlines? The Q1 2026 results were genuinely strong. Adjusted EPS of $1.19 beat estimates by over 10%. Revenue of $14.6 billion grew more than 10% year over year and beat consensus. Premium, loyalty, and business travel all grew double digits. Operating cash flow was $4.8 billion in a single quarter. The underlying airline is performing well.
The complication is that Q1 happened to coincide with a fuel spike that has no clear resolution date. The guidance cut to 7 to 11 adjusted EPS for 2026 is large enough to meaningfully change the investment math. At $9 in EPS, the midpoint, the stock trades at 10.8 times earnings. At 11, it trades at less than 9 times. At 7, it's essentially pricing in continued fuel pain. The strategic direction is right. Premium cabin growth, loyalty compounding, fleet renewal, but United is an airline, and airlines are cyclical fuel consumers in a world where geopolitics just reminded everyone that commodity exposure is real. The key metric to watch is simple: jet fuel prices, and United's ability to hold premium revenue growth even as economy demand softens.
We'll leave you with J. Scott Kirby's words from the April 21st earnings call. He said, "These are results our employees can be proud of, and they show the resilience of our long-term strategy, even in the face of escalating fuel expense." A CEO who took the job at the worst possible moment in aviation history, built a premium cabin strategy through the rubble, delivered double-digit revenue growth, and then had to stand up and tell the street his full-year earnings were going to be 40% lower than planned because a geopolitical event changed the cost of his primary input. That is the airline business. That's going to do it for this episode of Charged Alpha, your deep dive into United Airlines Holdings, ticker UAL. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.